Hello and Assalamu alaikum. My name is Zeeshan Hasan, and I'm the tutor of ACCA various subjects. And in this session, what we're gonna do, we will do the performance measurement on past paper, right from, as you can see, sample questions of September December 2021 from exams, right? So straight away, let's move to the scenario one question. As you can see in front of you. So our first requirement, firstly, you remember, uh, look at the requirements first. Okay. So calculate the optimum production plan. And okay, remember, whenever you get the and in the question, break the question in the two part. So first part is calculate the optimum production plan and the resulting total contribution earned for March, assuming that that order with Run Wild is supplied in full. First scenario. Second scenario, calculate the maximum financial penalty Bellows and Company would be prepared to accept from Run Wild if it does not complete Run Wild's order in full. So first requirement, two parts, 7 and 4, 11 marks available, right? So, and finally, discuss whether Bela Hosting Company should fulfill Run Wild order in full in March. 4 marks for the discussion. So, um, let's look at the scenario now. Here, Bela Hosting Company manufactures three types of running shoes, which it sells to sports clothing retailers. Road, which are for running on roads. Okay, one is uh, three types of shoes which it sells to sports clothing retailers. Road, which are for running on road. Spikes, which are used for racing on athletes' tracks. And trail, which are used for running off road in rural locations. Each of these products use different amount of the same resources, financial information, and the requirements related to given are given as follows. So what I did, as you can see over here, spikes, road, spikes, and tail. Total requirement are my heading. Okay. Now, road spikes tail. Selling price per pair of shoes 60, 45, and 52. Okay. Variable cost per pair of shoes. Direct material $5 per meter. 7.536. Direct labor $7 per labor. 7, 10.5, and 7. Machine hours. uh, Machine hours 10 per hour. 4, 2, and 3. Fixed overheads absorbed per pair of shoes 4, 6, and 4. Profit per pair of shoes 37.50, 23.50, and 32. Okay. Demand for the three products for the month of March is expected to be 2,300 pairs, Spikes 1,400 pairs, Trail 1,650. Okay. Belos and Company has received a special order from Run Wild, which is not included in the demand estimates above. Run Wild are a major sports retailer who have an extensive customer base and are known for stocking the most popular brands of sports wear. The order is to supply a maximum of 200 pairs of each type of shoe at a discount of 8 and the standard selling price. Run Wild will charge a financial penalty if the order is not fully complete in March. If the first order is successful, Dunwild would be keen to enter into a regular supply contract. Usually, Bela Houston Company has sufficient resources to meet production. However, during March, the maximum availability for the following resources has been identified: direct material 7,200, direct labor 6,900, and machine time is 1815. Okay, demand and resource availability. Baylor Houston Company predicted that the resources availability in March would continue into April. However, it has been discovered that the availability of direct material and labor will be 15% less than in March. The availability machine time and demand estimates are unchanged. Runwell would not be placing an order in April. Okay, so um, as you can see, direct material. Coming over here now. As you can see, direct material. As we just seen here, direct material is 755, 7.5. So divided by the number of units, it's gonna be 1.5 per unit. Okay. Spikes gonna be 0.6 and trail gonna be 1.2. Okay, direct labor in this case, 7 divided by 7 is 1, 10.5 is to 7, 1.5 and 1, right? Now, pair hours, zero point 0.4, zero point 0.2 and zero point 0.3 based on uh, the each pairs. Machine time 1815 hours available, whereas uh, these requirement is high. Okay, so based on the machine time is limiting factor. Calculate. Now we have to calculate contribution per unit of limiting factor. So contribution per unit of shoes sales minus variable cost, that is material and labor, will get 41.5 for road, spikes 29.50, and trail 36. Machine hours required is zero point 0.4, zero point 0.2, and 0.30 per unit. So contribution per machine hours gonna be 103. So how we got them? 41.50 divided by 0.40, 29.50 divided by 0.20, and 36 divided by 0.30. So contribution per machine hours are 103.75, 147.5, and 120. Ranking, road is third one, spikes is first one, and trail is second one. Now, what we gonna do? We have to prepare optimum production plan and calculate uh, resultant total contribution earned. Okay, so machine hours used, contribution per pair of shoes, and total contribution. So fulfill customer order in first case, uh, 200 road, apply 1815 hours available, right? So for the first product, road, it's 80 hours. For spikes, it's 40 hours. Just multiplying by the number of products. So and 60 hours. We'll get now pair of shoes 23.5, 21.5, and 28. Contribution is 6,700, 4,300, and 5,600. Total hours remaining after it 1,635. Okay. Now apply the ranking. 1,400 spikes first, 1,650 trail second, 2,150 road third. Machine hours used 280, multiplied by the number of units into hours 280, 495, and 860. Contribution pair of shoes 29.0 multipliers will get 41,300. 495 multiplied by 36 will get 59,400, and 860 multiplied by 41.5 will get 89,225. So in total we'll get 206,525. Now the second requirement, of A part. Calculate the profit maximizing thing. In this case, machine hours use contribution per pair of shoes and total contribution. This is just the copy paste of the previous part, which we just did. So apply ranking in general sales in March, 1400 spikes, 1650 trail, and 2300 road. So machine hours used 280, 495, and 920. So 120 hours will be remaining after that. Contribution per pair of shoes 29.5, 36, and 41.5. Total is 41, 300, 59, 495, 450. 120 hours are available. Okay. Now, in case of special order, 200 spikes, 200 trail and 50 trade, 40, 60 and 20 other machine hours, contribution 21.56, 28 and 33.5, 4300, 5600 and 1675 is the total contribution. Total we get 207,725 in this regard. So the loss of contribution for fulfilling uh, revised order is 207,000 1725 minus the normal one 206 525, so 1200. Therefore maximum financial penalty would be 1200. Okay, in this case. So we have another alternative approach in this case. Although the contribution earned is higher, okay, although the contribution earned is higher, if the order is only partially completed, if Bella Hosting Company does not fully complete the order, then Run Wild may not enter into a regular supply contract, and future sale revenue would therefore be lost. In addition, the customer base and reputation of the Run Wild will uh, therefore will help to market Bella Hosting Company products and hence increase awareness of their products. This benefit will also be lost if Run Wild choose not to order from Bella Hosting Company again. It would also not be good for Bella Hosting Company existing reputation if it becomes uh, becomes if they become known for fulfilling its obligation, it it could made other sport retailers reluctant to order from them. So now the last part, as you can see, define the variables and formulas, the constraints and objectives, functions to be used in linear programming model to determine the optimum usage of resources in April. 5 marks available for it. So what I will do, R is equal to number of pair of road shoes, S is equal to number of pair of spike shoes, and T is equal to number of pair of trail shoes. Now for constants, I will use 1.5 R plus 1.6 S plus 1 P is equal to 6120. Direct labor 1 R plus 1.5 S plus 1T less than or equal to 5865. Machine time 0 0.4 hour plus 0.2 S plus zero point 0.3 T less than or equal to 1815. Now the demand is R is less than or equal to 2300, as is equal to or greater than less than or equal to 1400. T is less than or equal to 1650. Non-negativity constant R comma S comma T is less than or equal to 0. Objective function is gonna be 441.50 R plus 29.50 S plus 36 T. Okay. So far so good. Now we have next requirement. Uh, in fact, we are done with all. No. Discuss bailout company should fulfill Renwald's order in full in March. Uh, yeah, here it is. We already did that. Now, sorry, we are already discussed the B part. I'm sorry, I'm not well. Actually, I had an accident a few days back and in lots of pain. So I don't know how I'm managing for you guys to teach you guys. It's my duty, and obviously I'm a little greedy as well that you guys make career for me as well. So now, second scenario, analyze the financial performance two airlines, including reasons for the difference in two businesses. Use the headings profitability, liquidity, and structure your answer. There are up to 6 marks available calculation. That means 8 marks for theory discussion. Then briefly explain the Fitzgerald and Moon building block model could be used to manage the performance of a service 6 marks. So um, let's look at the scenario. The country of the Joyland has two airlines, Black Company, its national airline, and Budget Company, a recent entrant into the market. Black was government owned until 10 years ago, but it is now operated as a private company. Its mission is to be in the airline of a choice for long distance travelers. It changes charges premium fares and operates from route from Jayland capital city to the major airports serving the largest cities around the world. Many of its flights have durations greater than 12 hours. The majority of its passengers are traveling on business and are prepared to pay high prices. However, the demand for the business travel is very sensitive to economic conditions. Its fleet of aircraft is regarded as aging by industry analysis. Budget company was founded by wealthy entrepreneur who invested their personal fortune in the company's equity. Its mission is to be the lowest fare airline on any route we serve. It offers flights to destinations up to 3 hours travel from Jayland. Its flight of aircraft are generally less than 2 years old. Most of its passengers are holidaymakers, and the demand of its flights appears to be relatively insensitive to economic conditions. We have a statement of profit or loss, total revenue, flag company, 11,333 million, and 6,654 million for budget company, operating profit 1,239 million, 404 million for budget company, finance cost 250 and 50 million, other non-operating costs 130 and 76 million, PBT profit before tax 859 and 278 million. Okay, non-current assets 11,972 million, 3,177 million, current assets 3,404 million and 885 million, total assets 15,376 million and 4,062 million, total equity 4,598 and 1,945, non-current liabilities 5,078 1,001, current liabilities 5,700 and 1,116, total liabilities and shareholders equity 15,376 and 4062. So other information for year end 31st December X6 is aviation fuel liters consumed millions 2434 1246, available seat kilometers 21,423 14,953, passenger seat kilometers 14,201 and 14,206, operating gearing 950 and 820. So firstly, we will discuss the profitability. In this regard, ROCE, if you know PBIT divided by capital employed, 12.8 and 13.71, operating margin then, you all know the formula 10.93 and 6.07, asset turnover, asset divided by liabilities 1.17 and 2.26, Budget company has so what I'll say, we'll say over here in the discussion, budget company has better ROCE, therefore making better return for its investors. The main reason of this is budget company's ability to generate sales. For every dollar of capital employed, it generates 2.26 of our sales revenue as compared to only 1.17 in case of flag company. Budget company has much shorter flight time than flag company and therefore could be making more journeys and spending less time period at airports. Budget company earns a lower operating margin than flag company as budget company operating cost as a percentage of revenue are 94% compared to flag company 89%. This is probably due to budget company pricing strategy. Now, the analysis on other information, seat occupancy rate 66.29, total number of seats occupied divided by unoccupied, it's 66.29 and 95%. Available seat kilometer per liter of fuel. So, available seats divided by fuel per kilometer, 8802 and 12,001. This is probably a consequences of its low fares policy resulting in higher sales of seats relative to flag company and for therefore a higher seat turnover. The better fuel economy is probably related to budget company newer fleets. Okay. Now, liquidity. Flag company and budget company, 0.60 and 0.79. How I got that? Current assets divided by current liability. So the current ratio of both companies are below the 2 is to 1, which is the norm. However, there are service companies which carry less or little inventory, so it is not worrying. There is no apparent reason for the difference in both companies. There is no comparison given in the scenario. Then risk, capital gearing, debt divided by equity, 110.44% and 51.47%. Interest cover 4.696 times and 8.08 times. Operating gearing 950% and 820%. So flag company has relatively high level of long-term borrowing. This adopt to the risk of beginnings as interest on the borrowings to be paid to make the company's operating profit. At present, its operating profit is nearly 5 times than uh, interest bill and appears to be able to comfortably pay its commitments. Its operating profit is 950%, indicating that if sales volume fell by 10%, its PBIT would fall by 95. So this would cause flag company difficulty in covering its interest payments as demand for business travel is very sensitive to economic conditions. There is a strong probability that at some point flag company will experience a fall in sale volume, while budget company carries a financial gearing low gearing than financial gearing than flag company and has better interest cover and operating gearing is slightly lower given its relatively insensitivity to economic conditions. It can be considered a safer company than flag company. Now, finally, we have last requirement, which saying briefly explain how Fitzgerald and Moon's building block model could be used to manage the performance of a service business. 6 marks available. Simply, it's a knowledge-based question. Fitzgerald and Moon's building block model provide a framework for service companies to design performance system which are linked to the management rewards. It provides a system of targets to which will not motivate managers to improve business performance. There are three building blocks in the model. The first block Give six dimensions, means aspects of performance which must be measured. These are financial performance for profitability and growth, quality of service offered, competitiveness, flexibility of organization, innovation, and resource utilization. So these six dimensions should split into results which are the outcome of past decisions, that is quality, flexibility, innovation, resources utilization, which drive future performance and results. So as this part was knowledge based, but for this part, what I did, the technique for the part A, simply calculate the ratios, uh, explain the each ratio that either company is going good or bad, compare the other company, either they are doing the bad, connect with the scenario and give your reasons. If you um, noted me, I did for each ratio the same thing, and that's what you need to do, which is not very difficult. I hope this session helped you. uh, I would love to hear your feedback. So do let me know. Uh, that's it for this session. I'll see you next time.